Japan is quietly doing something that has enormous consequences for the United States, for global financial markets, and for every person who depends on affordable borrowing, whether that's for a mortgage, a credit card, a car loan, or a business loan. The world's largest economy is built on debt. And for decades, one of the biggest buyers of that debt has been Japan. But that era is ending. Slowly, steadily, and very deliberately. Japan is reducing its holdings of US Treasury bonds. The numbers are clear, the trend is real, and the implications are far bigger than most people realise. This is not a sensational crisis story. This is the start of a long-term structural shift, one that changes how the US government finances itself, how global interest rates behave, and how fragile the world economy truly is. For context, Japan has been a cornerstone of America's borrowing system for more than 30 years. For decades, Japanese institutions, especially major banks, insurance companies, and pension funds, bought US government debt in enormous quantities. They did it because American Treasury bonds offered something Japan could not: higher yields, more attractive returns, and a stable place to park massive pools of savings. At one point, Japan held over $1.2 trillion in US Treasuries, making it the single largest foreign lender to the United States. In other words, Japan helped subsidize the American government's spending habits. Japan's demand for US bonds made it possible for the US to borrow at low interest rates. It kept American mortgage rates, credit rates, and business borrowing costs far lower than they otherwise would have been. It was a financial relationship that benefited both sides for many years. But this relationship is now reversing. And what's important to understand is that Japan is not selling treasuries because it suddenly dislikes the United States or because it wants to hurt the American economy. None of that is true. Japan is reducing its US bond holdings for three very simple, very rational reasons, all of them grounded in economics, demographics, and domestic financial priorities. And the first reason is the most important of all. The interest rate gap between the US and Japan has changed dramatically. For more than a decade, Japan has kept its interest rates at or near zero. In some periods, the Bank of Japan even kept short-term rates below zero. During that time, US interest rates were consistently higher. That gap encouraged Japanese institutions to send money overseas. Why hold Japanese government bonds at near zero returns when you could buy US Treasuries at 2%, 3%, or 4%? It was rational. But in the past 2 years, the Bank of Japan has begun to shift. Japan's inflation, which used to be stuck near zero for decades, has finally begun to rise. That forced the Bank of Japan to relax yield control, allowing Japanese government bond yields to move higher. And they did. This brings us to a crucial moment, and to a number that financial analysts have been watching very closely. As your direct quote explains, there's a number that's been quietly haunting financial analysts for weeks now. Most people have never heard of it. Even fewer understand what it means. But this number is about to change everything for American families. That number is 1.71%, and it represents Japan's 10-year bond yield, which just hit the highest level since 2008. And yeah, we get it. Bond yields? Sounds like the most boring topic imaginable. The kind of thing that puts you to sleep faster than a congressional hearing on C-SPAN. But here's the thing. This seemingly mundane percentage is the reason American families could lose $5,000 to $15,000, and almost nobody is talking about it. This quote matters because it captures the heart of the truth. Rising Japanese yields fundamentally change global capital flows. When Japanese 10-year bonds pay more, Japanese investors keep their money at home. They no longer need to go overseas to chase higher returns. That one number, 1.71%, is not just a statistic. It's a signal that Japan's era of ultra-cheap domestic bonds is over. And when Japan offers more attractive returns at home, Japanese investors step back from US Treasury purchases. That shift is not hypothetical. It is happening right now. The second reason is demographic. Japan is the oldest major country in the world. Its population is shrinking. Its workforce is shrinking, and its pension obligations are getting larger every year. As the population ages, domestic financial institutions are under pressure to keep more capital inside Japan. Japanese pension funds, insurance companies, and banks need to ensure they can meet the long-term needs of an aging society. That means holding more domestic bonds, not foreign ones. Japan's aging demographic is not a short-term trend. It's a structural, long-lasting reality. And that structural shift reduces Japan's appetite for foreign debt. This is not politics. It's simple math driven by a population. The third reason Japan is reducing its US Treasury exposure is currency stability. The Japanese yen has been extremely weak against the US dollar. A weaker yen makes imported goods more expensive for Japanese households. It increases energy costs, food costs, and manufacturing inputs. The government and the Bank of Japan are under pressure to support the yen when it falls too sharply. One way they can do that is by selling US Treasuries and using the dollars to buy yen in the currency markets. Japan has not done this aggressively in 2025, but it has done it in the past, most recently in 2022. And investors know the possibility is always there. This means Japan needs to keep reserves flexible. Reducing Treasury holdings gradually gives Japan more freedom to stabilise its currency when needed. These three forces, rising Japan yields, an ageing population, and currency pressures, explain why Japan sold large amounts of US Treasuries in recent quarters. In the third quarter alone, Japanese investors sold roughly $60 billion worth of US bonds. That is not a small move, and it is not a temporary move. The trend line shows that Japan's holdings have been declining steadily from their peak and are now at multi-year lows. But here is the key point for viewers. Japan is not dumping treasuries in a panic. It is methodically reducing exposure because its own domestic conditions have changed. This is rational economic behaviour, and that's why it matters even more. Now, the big question: why does this matter to the United States? To understand the impact, you need to look at how American debt works. The US government runs large deficits. It borrows trillions of dollars every year, so someone has to buy that debt. For decades, foreign buyers like Japan and China helped keep American borrowing costs low. But those days are ending. China has also reduced its holdings in recent years due to geopolitical tensions. Japan is now reducing for economic reasons. That means the US government must rely more heavily on domestic buyers, banks, pension funds, money market funds, and institutional investors to buy its debt. And domestic buyers will demand higher yields if they are expected to absorb more of the US Treasury market. This is one of the reasons US Treasury yields have remained high. Even when inflation has cooled, even when economic data has softened, yields remain elevated because the world has changed. The era of massive foreign buying is fading, and the result is simple: higher borrowing costs for everyone. When Treasury yields rise, the effects are spread across the entire economy. Mortgage rates rise, credit card interest rises, car loan rates rise, corporate borrowing becomes more expensive, government interest payments soar. This is why Japan's steady retreat from US Treasuries is so significant. It changes the global demand structure for the safest asset on Earth: US government debt. And if you want to understand what that means for ordinary American families, the impact can be summed up in one blunt explanation: the $15,000 question. Here's what this looks like in real life. So you're planning to buy a house. Last year, you could get a mortgage at 6%. This year, try 8%, maybe 9%. That difference could mean an extra $500 to $800 per month on your mortgage payment. Over a year, that's $6,000 to $9,000 just on housing. Need a new car? Car loan rates are climbing. That's another $100 to $200 per month. Then there's the job market. Companies are paying more to borrow money, so they're cutting costs. That means layoffs, hiring freezes, and smaller raises. This is not theory. This is exactly what happens when borrowing costs rise across the economy. The Federal Reserve sets the base interest rate, yes, but global demand for US Treasuries sets long-term yields. When Japan and other major foreign buyers reduce their Treasury holdings, the US must offer higher yields to attractive new buyers. Those higher yields then ripple straight through to mortgage rates, car loans, credit card interest, and business financing. That is how a seemingly distant technical change in Japanese investment behaviour translates directly into thousands of dollars in additional costs for ordinary American households. One of the clearest signs of this shift is found in the US government's interest payments. America now spends more on interest than it does on defence. That is a direct consequence of higher Treasury yields and higher debt levels. When major foreign lenders step back, the US must pay more to borrow. Japan's decision to reduce exposure contributes to that long-term upward pressure. Again, this isn't a crisis, but it is a structural change that will shape America's financial future for decades. Another important point is currency flows. When Japanese investors bring money home, it changes the supply and demand balance for the dollar. Less foreign demand for US assets can weaken the dollar over time. It can also increase volatility in global bond markets. Historically, Japan has been a stabilising force. When markets were chaotic, Japanese institutions often stepped in to buy treasuries because they needed safe, long-term assets. As Japan steps back, that stabilising force is reduced. The world becomes slightly more fragile. There is also the issue of regulatory pressure in Japan. In recent years, Japanese financial regulators have encouraged insurance companies and banks to reduce currency risk. Many Japanese institutions historically hedged their dollar exposure, but hedging has become more expensive as US rates have risen. When hedging costs rise, the attractiveness of holding US Treasuries declines sharply. This is another technical but important factor driving the reduction. What's crucial for viewers to understand is that none of these forces are short-term. Japan's demographic pressures will last for decades. Its bond yields are unlikely to return to zero anytime soon. Hedging costs may remain high as long as the US Federal Reserve keeps interest rates elevated. All of this means Japan's reduction in US Treasury holdings is not a one-off event. It's a long-term structural trend driven by deep, slow-moving forces. So where does this leave the United States? The US government still has a massive appetite for debt issuance. Trillions of dollars must be refinanced every year. Trillions more must be issued to fund government spending. With foreign buyers stepping back, the US must attract domestic buyers or new foreign buyers by offering higher yields. That translates into a world where borrowing is more expensive, not cheaper. It means a world where interest rates remain structurally higher than the last decade. It means a world where the US government's debt burden grows faster because of rising interest costs. None of this means the US is collapsing. None of this means a financial disaster is imminent. But it does mean the assumptions of the last 20 years, cheap money, low rates, endless foreign demand for US debt, are over. Japan's reduction in Treasury holdings is one of the clearest signals that the global financial landscape has changed. And the sooner people understand that, the better prepared they will be. In the end, Japan is not acting emotionally. It's acting rationally. It's responding to rising domestic yields, an ageing population, high hedging costs, and the need to stabilise its currency. These are legitimate economic reasons, but those reasons have global consequences. And those consequences shape everything, from the price of a home in America to the cost of borrowing for small businesses to the stability of financial markets around the world. The age of cheap money is gone. Japan's shift is one piece of that larger story, a story that will continue unfolding over the next decade. For investors, homeowners, policymakers, and everyday citizens, understanding this shift is not optional. It's essential. Because whether people realise it or not, the world's financial system is already adapting to a new reality. Foreign lenders are stepping back, domestic demand must fill the gap, and borrowing will not be as cheap as it once was. Japan is not dumping US debt in a panic, but it is reducing its exposure decisively. And that marks the beginning of a new era in global finance, one defined by higher rates, tighter liquidity, and a world where the US can no longer count on the same foreign support it once enjoyed.